This was supposed to be a time of expansion post-pandemic as services came back to life and stimulated growth. Instead, inflation, both imported and homegrown, is threatening that prosperity. And as our central bank works to put the fire out, will they do untold damage to the building? Jim Stanford is chief economist and director at the Center for the Future of Work. Jim, great to have you with us.
Thank you, Amanda.
So this is one of the central questions of the day, and that is, will our central bank go too far? They want to rein inflation. They've been very clear. It caught in the middle, of course, are a bunch of real humans whose wages may be rising now, Jim, but for the most part, not enough to keep pace with the inflation we're seeing, and who are now staring down the barrel of a recession and potential job losses. Are we getting it wrong here?
I think we are, Amanda. The Bank of Canada is ahead of most other central banks in the industrialized world. Along with the U.S. Fed, the Bank of Canada has increased interest rates by faster than other central banks. And I don't see the need for us to be a leader in that race. Obviously, people are concerned about inflation, but we're also concerned about where the rest of the economy is going. The bank's line that the Canadian economy is overheated, that demand is too strong, that labor markets in particular are overheated, I don't think is consistent with the evidence. The second quarter numbers were not strong, and the third quarter are going to be much weaker already, and we're not getting the full effect of the interest rates that are already in the pipeline. So I think this should be a time for the bank to take a deep breath and hold on and watch what's happening. Unfortunately, they signaled they're going to go again come hell or high water.
We have heard an awful lot of talk for months now, Jim, about the tight labor market and how it's time, labor finally has some bargaining power, and maybe some people do feel their power. I think most workers don't feel their power. They feel like they're working for the same parsimonious company they always did. But if we look down the road at what may be coming, is the moment over? Are we going to see a weaker labor market and some of that wage power disappear?
Yeah, that would be a heck of a shame, I think, because it's really the first time in decades that, workers have had in a way, an abundance of job opportunities to go to. Think of particularly, say, young adults who until recently really could hope for a gig and then maybe another gig. Now they've actually got a chance at some decent work, and this is a good thing, not a bad thing. And it has not contributed to a wage price spiral. There's no evidence of that at all. Real wages are falling, and falling pretty quickly, which means, it's a very unusual kind of shortage when the thing that's in short supply, workers, are actually costing less, not more, in real terms. So I think it's a mistake to squelch this moment before really the benefits of it have trickled down. And I think that it's in a way, it's going to be a cure that's worse than the disease.
We have these slow-moving problems. We've talked a lot about them recently as well. Demographics, our retirement rate is suddenly booming once again, and it's capturing younger and younger, 55 and up now, workers, people we can't really afford to lose. Are we going to see a more strategic effort on keeping employees happy, on keeping them in the labor force? Because, of course, when a 55-year-old retires, they take an awful lot more than their relatively high salary. They take a lot of knowledge and experience.
And in many cases, Amanda, some of those retirements are just people, throwing up their hands and saying, I can't take this anymore. That's certainly been the case in public services, healthcare. You've seen a lot of those retirements, and as people are burnt out. And by the way, their pay is being suppressed in Ontario at 1% a year. 1% a year was bad enough when inflation was 2%. It's intolerable when inflation is 7%. So I'm not surprised that those people are giving up on work. On the other hand, the overall labor force participation is still relatively strong. So I don't think that this is truly an issue of a shortage of workers, but I do think it's perverse and self-defeating to chase people out of the labor market with falling real wages and now the prospect of a recession. Yet that's exactly what we're doing right now. Jim,
so good to have you. Appreciate your time.
Thank you very much.
Jim Stanford is an economist and the director of the Center for the Future of Work. Time for the takeaway and the winners and losers of rising interest rates. It's easy to feel like there are no upsides to rates climbing. We hear a lot of talk about how it will dampen our economy, if not send it into outright recession. And while those high rates choke off growth and threaten jobs, they also make our debt more expensive. So that for a period of time, efforts to fight inflation and make our lives more affordable have the opposite effect. We get poorer and our incomes are put at risk as our employers feel the pinch of an economic slowdown. But let's not forget that higher rates are actually just returning to normal. Removing the emergency measures in place after the great financial crisis and then the pandemic, it should be welcome news that it's time for that. And it's worth remembering, not everyone is in debt. In fact, for the first time in about 12 years, people who tend to save rather than spend may finally be rewarded as returns on risk-free savings like bonds start to look a little better. And in a less obvious way, all of those who borrowed but didn't go too far should be just fine as rates rise a little. And of course, if rising rates and a cooler economy help send some prices down, that improves affordability for some. Houses, for one thing, may be a little more reasonably priced. As for the losers, they're obvious. The heavily indebted, the less prudent, those who spent as though circumstances would always be good. Unfortunately for all of us, that description applies to our government. In fact, one of the conundrums of rates rising to cool inflation is that governments with a lot of debt have much to lose. In fact, while they may publicly bemoan high inflation as being hard on voters, inflation is not bad for them. It makes their debt more affordable while raising their revenues through windfall taxes, thanks to higher priced goods and services. My takeaway, as interest gets pricier to try to cool inflation, there may be some short-term pain. But the real winner in this scenario could be future generations of Canadians if it forces governments to also consider living within their means. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.